Welcome to Swimming with Allocators. I'm Ernest Sweat, and each episode, Alexa Benz and I give you a VC podcast from the LP perspective. You ready? Let's dive in.
Welcome to Swimming with Allocators. Today, we're chatting with Michael Ashley Schulman, Chief Investment Officer and founding partner of Running Point Capital.
Today's conversation was an awesome one that I look forward to sharing with you all. We learned what everyone needs in their signature line as a fund manager. We learned 3 key criteria in selecting emerging managers. And lastly, Michael gave us a great take on what new allocators should do to win at venture. So with that, let's dive in.
Today, we are speaking with Michael Ashley Schulman, Chief Investment Officer and founding partner of Running Point Capital Advisors. Running Point is a multifamily office with a holistic approach dedicated to the total well-being of their clients and their families. We are grateful to have you here today, Michael. Based on your reputation as a thought leader in the family office sector, thank you so much for joining us.
Thank you, Alexa Benz, and thank you, Ernest Sweat. Pleasure to be here.
Thanks, Michael. So I wanted to start it off by just getting the origin story of how you kind of came to, Running Point Capital Advisors. So could you take us on what your journey to this point has been, and what are the most pivotal moments that inspired you to create Running Point?
Thank you, Ernest. Happy to. A bit of a long story, but I'll try to be quick about it. I'll start young. I bought my first stocks when I was 6 years old. Like children do, I collected Halloween candy, but I wasn't much of a candy eater. So I sold the candy on the school bus. Bus drivers, of course, got a discount. I donated 10% of revenue to charity and invested the remainder. When Halloween candy ran out, I bought wholesale, then marked it up. Instead of putting it in a bank, I bought stocks. Started with 2 stocks, did it as a hobby. Through elementary school, high school, when I graduated UC Berkeley, I realized this thing I had done as a hobby, I could make a career out of it. I started out my first 7 years managing institutional money, huge stock and bond portfolios for companies like Blue Shield of California, Holland American Cruise Lines, Taft-Hartley Union Funds, pension funds, fire and police funds, and so forth. Did that for 7 years, went to MIT for my MBA, had a phenomenal time there, focused on tech strategy and entrepreneurship. Actually, when I graduated MIT, I started with an MIT startup out of the Media Lab. I worked there for a while, did some tech consulting, and then went back to the investment side, doing complex bond modeling for Deutsche Bank. And since 2005, have been managing money for wealthy families. About 4 years ago, we started Running Point because it's one thing to just manage money for wealthy families, but we thought it would be much better to create a firm where we provided all things financial under one roof for the families.
Wow, there's so many places I can pull threads on just on that origin story. But first, I just wanted to just ask: was there always just an entrepreneurial spirit like that you learned from your family, even taking that on of like selling candy and
candy
and all that
man?
stuff?
Yeah.
Yes, I think there was a bit of an entrepreneurial spirit in my family, especially with my mom. She started a medical supply business that was very successful. And as a single mom, I always looked up to her.
Oh, wow. That's truly inspiring. And so then the other thing I wanted to ask is, I started my career out in equity research, so very familiar with like the public stocks. How did you make the transition of getting an interest in, venture, and kind of how has that shaped? How did that first experience in public stocks shape really your perspective on venture, having an interest for it, and then how to apply those thinkings to like this asset class?
There's a well-known quote: "When the facts change, I change my mind. What do you do?" It's been attributed to John Maynard Keynes, but without any proof that he actually said it. From my perspective, there are countless long-term studies that show that small cap stocks, public stocks, like you mentioned, Ernest, outperform large cap. However, much of the financial literature or textbooks that we study as professionals was built off of data from the 20th century, especially post-World War II, 50s, 60s, 70s, 80s, and 90s. Thus, many pundits have built their careers off of this size factor and keep expecting it to return to the stock market. They keep expecting small cap to outperform large cap. They believe in this reversion to the mean or reversion to the average, and that small cap performance will return, and not only return, but come roaring back, kind of like Harrison Ford and Indiana Jones, and leave large cap stocks in the doldrums. Why? Well, because for the last 2 decades, small cap has horribly underperformed large cap. Yet they keep beating the drum for small cap. Now, as for me, I examine the data and try to figure out what has changed. And in the old days, tech companies used to IPO into the small cap index. And then that gauge would benefit as those tech companies grew and matriculated into mid cap and eventually large cap. But for the last 15 or 20 years, most successful tech companies do not IPO into small cap. Venture capital hangs on to them longer, nurturing them for a mid cap or large cap IPO. So the small cap indices miss out on the upside. And even those that do IPO into small cap might not even be included in the index if they don't have positive earnings. Tesla is a fine example of that. Even though it IPO'd as a small company, S&P did not include it in its index until it turned a profit. And by then, it was worth hundreds of billions. So why look at VC? Well, the nature of stocks has changed. The small cap indexes, which used to benefit from technology, that benefit is now being held on to longer by venture capital. So I'm following the money and going where the money and the growth is.
Makes a lot of sense. And you all at Running Point are renowned for a unique investment philosophy. Can you talk through this philosophy and how it's leading to great outcomes for your clients?
Thank you, Alexa. Our philosophy is that we are acquirers of assets and long-term stewards of your capital. We tailor investment allocations to your specific interests and needs of tax efficiency, generational wealth, income growth, total return, or preservation of capital. And fundamentally, we believe that some markets are more inefficient than others. Therefore, how you invest in them matters. Alternative or private investments like real estate, credit, private equity, and venture capital can add value to a high net worth portfolio. And many of these private asset classes like venture capital have an advantage that public company investors don't. Venture capital, private equity, private real estate can benefit from inside information on their private companies and on their deals. Insider information is completely illegal in the public markets, but perfectly okay in venture capital, private equity, and real estate. Thus, a well-constructed strategic asset allocation helps protect and grow wealth over time and is central to successful long-term performance. And along with that, tax efficiency is critical to the investment plan.
Given your extensive experience in the high net worth portfolio management, can you share any advice you have for new entrants as allocators in the VC space? Yeah, specifically, what strategies or due diligence processes do you recommend that they navigate the world of venture?
My recommendation or suggestion is to take your time. Build your due diligence network. Get references on the venture capitalists and the firms and their staff, and follow up on those references. So many times I see people get references, but then not make the calls. Now, if you don't have time to do that because it's a lot of work, then bring in a professional multifamily office like us, or a platform like Allocate, or Bridge Funding Global to help and guide you. From my observations, venture capital, VC, is a very tight and cooperative community. And in the investment world, we often think of investors as very competitive. But venture is unique in that cooperative aspect. Someone a venture firm does the pre-seed, they need another VC to take the lead on the seed, and then another to lead the Series A, and so forth. It's unlike any other investment space. No real estate developer builds the first 4 floors of a building, then brings in another developer for floors 5 to 9, and a third developer for floors 10 to 16.
You're crossing your fingers hoping somebody puts a roof on it.
Exactly. But
That's-
funny enough, that's how VC works, and it works very well in that respect.
I love that analogy. This is a relationship business. You talked about doing references. How have you seen GPs build long-term relationships with yourself? Managers who are listening would, I think, love some ideas on how to foster that like mutual trust and long-term relationship.
I've seen GPs build long-term relationships with me by keeping me in the loop. With emails, occasional phone calls, not pestering me, but providing me access, being genuine, sharing information, divulging their wins and their losses along the way, and the lessons learned. That's super important. On top of that, also, I ask VCs to remind me who they are. I've seen over 120 venture decks so far this year, and there's still a couple months left in the year. That's not to mention all the direct company investments, real estate, hedge funds, private credit, and private equity deals I've seen. The names become a blur. You as a VC may be unique, but if you think I remember your fund's name or cute acronym or what your focus is, no. 19 times out of 20, I don't. Might be even worse than that. And quite frankly, neither do my peers on the investor or LP side. So my request, and I ask this of any VC that I coach or provide guidance for or try to mentor, is please do us all a big favor and in your email signature, use one line to say who the fund is and its focus. Are you a Series A and B CPG venture fund, a pre-seed and seed logistics, early stage e-games or late stage cybersecurity fund, C2B general venture fund, etc., etc. And when I say that, I also point people to my own emails. I mean, I don't expect everyone to know who Running Point Capital is, but in every email I send out, I figure I have free marketing in my signature line at the bottom. And so every email I send not only provides all my contact info, which many VCs don't even provide, but it also says what we do. We deliver custom investment solutions, family office services, innovations, and unique perspectives to you and your family. We are your family office. You can emphasize your enjoyments, priorities, and legacy. That quote is at the bottom of every email, describes who we are, what we do, and reminds people of what Running Point is. And I ask that actually not only of venture capital funds, but of any fund that emails me, because it's hard for me just on a name to differentiate whether someone's private equity or real estate or venture capital or hedge fund.
Now we're going to take a quick break to speak with our sponsor.
With us today is Tyler Kirtley, partner at Gunderson Dettmer. PitchBook has named Gunderson the #1 law firm globally for investors 5 years in a row. Our guest Tyler is a dear friend from college. His practice focuses specifically on structuring, forming, and operating VC funds. Tyler is the darn loveliest lawyer to work with out there. Thank you, Tyler, so much for your advice and expertise. What advice would you offer for managers launching their first fund?
Yeah, so a few pieces of advice come to mind. One I've already mentioned, which is it takes a very long time to raise your first fund. Even if you have an exceptional background, an exceptional track record, it can take a lot longer, and you're going to have many more meetings with prospective investors than you think you will to get to the first close. And then once you get to the first close, it's going to be a long time until you get to your final close. So it takes a long time. You need to be ready to be in there for the long haul. And it's just a necessary step to raising a long-lasting firm. The stories that you sometimes see of people who raise their fund in a month, those are by far the exception rather than the norm. Two is when you're speaking with prospective investors, you should have a clear and concise pitch for one, how you source deals, two, how you differentiate between the deals that you've sourced and ultimately pick one over the 20 others that might look similar. And then three, once you've invested in a company, how you add value. So in other words, why is that company going to take your capital and put you on their cap table as opposed to anyone else? I think investors really care about that. Three is, and this is admittedly somewhat self-serving, but I think it's real, and we see it in our client base. Hire service providers that really understand your industry deeply. It may be more expensive than the alternative, but those service providers can be your partners and your guides for what the common market terms are, how you handle common issues that other similar managers face, and they can really help you set the foundation for a long-lasting firm.
Yeah, you don't have to reinvent the wheel. I just had a chat with our classmate Dimitri, and he said of his YC class, the people who tried to sort of get specific on terms or had anything that, this is obviously in a VC to founder relationship, but anybody who got really inventive or was really committed to something sort of out of the ordinary, those are the people who are no longer at it anymore. It's almost like you're focused on the wrong thing.
It's so true. Keep it simple. Don't try to come up with some brand new structure that no one's seen before. Just focus on building relationships, raising capital from investors, making great investments. Like, those are the keys for a venture firm, or in the company context. Focus on operations. Don't get wild and crazy with the terms of your financing.
And you're very helpful to your clients post fundraising too. You advise your clients on the day-to-day operations. What are some issues that managers have been wrestling with lately?
Yeah, that's right. So I'd say 70 to 80% of our work is actually raising the funds, and then we work with managers day to day. Right now, what we're talking most with our managers about is the panoply of new regulations that have come out. So the SEC's been particularly active. Last year, a new marketing rule came into effect for registered investment advisors. So many of our clients are registered, and so we focused on that with them. Earlier this year, there was a new final rule related to Form PF reporting that also impacted registered advisors. And then the big one was a couple of months ago, the SEC came out with a final rule, as the new private fund advisor rule, that impacts both registered advisors and exempt reporting advisors, such as VC fund managers that rely on the VC exemption. So our clients are spending time trying to understand how that's going to impact their operations and how to plan for those rules going into effect. And then states are also getting into the mix. So California, I don't know if you saw, recently came out with a new founder diversity reporting requirement, where any venture firm with any kind of a nexus to California, that can include having an LP from California or having a single portfolio company in California. So it's not just having an employee or an office there. They need to go out and survey all of the venture investments in their portfolio and report on diversity of founders of those companies. And so our clients are trying to understand how to practically implement that when the new rules go into effect.
To get in touch with Tyler Kirtley or any of the other fabulous lawyers at Gunderson Dettmer on the fund formation team, you can find their profiles at gunder.com, gunder.com. And now back to our LP interview.
Now, with so much going on and with all the macro events, this investment landscape can be pretty dynamic. What do you see as challenges and opportunities for family offices, and how can they better navigate and capitalize on these conditions?
I believe most true family offices have a very long-term perspective. But fundamentally, inside the family office are people. And people can succumb to common psychological feelings and, behavioral economics, which means they can succumb to fear and greed. And when things look bad, they'll pull back their investments. And when things look really good, and they'll dive in. And so sometimes people miss out on the bottoms and put extra money in on the tops. And I think one needs a good financial roadmap and good financial plan. And most family offices have that in order to navigate and capitalize on volatile or uncertain economic conditions. But right now, valuations have contracted. It may be a good time to go in with fresh money, but no one wants to catch a falling knife.
Absolutely.
No, that particularly among family members, there's even different risk tolerances. So I'm sure that you are you see sort of the full swath of, as you say, behavioral economics.
Absolutely, we see much different risk tolerances in families. Amongst the matriarch, the patriarch, the children, definitely. And some children are more conservative, some are more aggressive. Sometimes the husband might be more aggressive, sometimes the wife might be more aggressive. It depends.
Yeah.
Everyone's different.
Family dynamics and financial dynamics. When it comes to evaluating and selecting investment managers, you have mentioned you've already met 120 this year. What specific criteria or data points are you looking at for venture capitalist managers in particularly?
At a high level, we look for three things. They must be smart, because we don't want any dummies.
Yeah.
They must have a niche or specialty that differentiates them from other people and other VCs. And they should already have their systems and processes in place for managing the fund and processing investments and guiding their underlying companies. Because I don't want them wasting my money or my clients' money trying to figure out how to set up shop and run their business. And I've seen many funds, be it hedge funds, venture capital, or other funds, fail because they didn't have their processes in place. Maybe they came from a larger shop and they did great there, but they were dependent on the larger firm, let's say a Goldman Sachs or Morgan Stanley, to keep them in line. Maybe they had some rough boss that they didn't like and couldn't wait to get away from, but that boss vetoed two of their ideas that would have blown them up previously. And now they don't have those systems and processes in place. On top of that, I want to know how venture capitalists make decisions. Sometimes you have a solo GP and it's pretty easy. They are the sole decider.
Yeah.
But when you have a team, I'm always curious how they make decisions. Is it unanimous? Is it majority? Or is it each one independently? And it's not that I really have a preference, but I really want to know how they formulate their decisions and why. And beyond that, I also want to judge the steadfastness and commitment of the whole team. Have they worked together previously? What is their commitment to sticking it through? What happens if the one person who brought you in leaves?
Wow, those are amazing, questions and insights that I think all allocators should be thinking about, and all fund managers should be thinking about how they're presenting that too. Kind of switching gears, are you finding any of your clients are interested in ESG and social impact considerations? And if so, how are you trying to meet those demands?
I believe that a lot of our smarter and more caring clients have seen through many of the faults and contradictions inherent in ESG investing as promulgated by the large institutions. ESG is inherently backwards looking. An ESG investor would probably never buy an oil company because it's dirty and polluting. but an impact investor might, because impact investing is forward-looking. And they might buy an oil company and say, geez, how can we make it cleaner? How can we make it more environmentally friendly? Oil is not going away or disappearing immediately. So what can we do to make society better? And I believe, our clients, the smarter ones, understand and believe that impact can make all of society better. Where ESG, because it's backwards looking, tends to maybe make a single company better. British Petroleum's a great example. They're striving for net zero. It's a good company. It's a good oil company. But in order to strive for net zero, they're selling off some of their dirtier assets. And they're selling them off to smaller players that won't be as environmentally minded as BP. So BP might be cleaner, but their oil fields they're selling off are being sold to lesser players, and the environment might be worse off because of that.
Yikes.
And that's why I say there's contradictions in ESG. You want diversified boards? Great. But actually, oil companies were amongst the first to diversify their boards ahead of many of the other industries. So how do you balance those contradictions? Whereas impact is forward-looking, they seek to make positive changes, and many of our clients seek to do that with their personal businesses and will do that with their investments also.
No, a parallel to ESG is maybe diversity. And Michael, you have a reputation for supporting emerging female managers in venture capital. Do you have any recommendation for allocators who are listening on what that process has been like? And certainly as a female manager, I would never want anybody to give me capital because I have a ponytail. But what that process looks like for you on even considering some people who wouldn't necessarily have been on your radar to start?
Well, I'd say if you have an interest in that, either please reach out to me at Running Point Capital and I can help, or better yet, reach out to Sophia Platt and Emna Gariani, the founders of Bridge Funding Global. Bridge Funding Global is a fundraising platform and investor community for top-performing women emerging managers. The vision for the platform is to provide all resources to women and underserved GPs to optimize their fundraising process and match them with deploying LPs and deploying investors. There are a lot of good venture managers out there, and there are a lot of not so good ones. And you can find them in traditional areas, which can be male-dominated, and you can find them in female-led. And there's some very, very good firms out there with very good investments. Some are Fund 1, some are Fund 2, some are on Fund 3 or later. So there's a wide variety to choose from. And I look forward to bringing more of those options to our investors. And some of them have reached out to me directly, but most of them I found via Bridge Funding Global.
Thanks for sharing that. Looking forward, what specific trends do you foresee emerging in the VC asset class? And can you detail how allocators should prepare for these shifts, offering insights into the strategies to adopt proactively?
Looking forward, I believe there may be a cleansing of managers. There are well over 7,000 or 8,000 VCs, incubators, accelerators, angel investing groups, and venture clubs. Honestly, I don't think there are enough novel ideas to go around to support that community. Therefore, think it through. If 60 people around the world have a similar brilliant idea, you need to do some scenario analysis and role play through which manager will be likely to see it, win it, nurture it, foster its success, and then pass it off to the next lead VC. As Darwin realized, it's not always the smartest or strongest that survive, but those most adaptable to change. So as we look out as allocators to prepare for the shifts, I think we need to be prepared for a cleansing of some managers and figure out who can adapt, who is smart, who is strong, and who is adaptable and will survive as a venture firm, and who can nurture the good ideas and the good people all the way through.
No, the Darwin is at work. Darwinian evolution in real time. Any parting words of wisdom or final thoughts for this audience? This has been delightful to hear how you're approaching this asset class. Thank you. Just hand you the mic.
Thank you. I've enjoyed speaking with both of you. For venture capital, if we're talking about the emerging VCs, the majority won't go beyond Fund 1, at least not in their current state. And maybe that's okay. They'll drop out, change firms, start over. I've seen it in hedge funds. Hedge funds is a perfectly successful asset area, but most hedge funds fail within 2.5 years. It takes a little longer for a new venture fund to figure out if their track record is good enough for a fund 2. And even so, by then, 4 years later, the partners may split. Mm-hmm. Strong solo VCs that can build their teams methodically, slowly over time, and strong Fund 1 teams that have worked together previously may have the best odds by building slowly and carefully. But looking forward, as long as interest rates stay elevated and money is no longer free, building and selling companies will be more of a challenge, more of a commitment, and more of an opportunity.
Thank you so much, Michael. Really appreciate your time and your thoughts.
Thank you, Alexa. Thank you, Ernest. It's been a pleasure being on Swimming with Allocators, which is a really, really unique name.
Thank you. Appreciate it.
See you later, alligator.
After Portfolio Tile, investing with a smile.